The early 1990s were a time of change for India. Economic liberalization had just begun, foreign investment was trickling in, and the Bombay Stock Exchange was buzzing with new life. Yet the financial system was still fragile, with outdated banking practices and weak regulatory oversight. In this backdrop, a young broker named Harshad Mehta rose to prominence, promising high returns that seemed almost too good to be true. Harshad Mehta, often called the Big Bull, started his career in the late 1970s, moving from a modest clerk to a full-time stockbroker by the mid-80s. He built a reputation for aggressive trading and a knack for navigating the grey areas of the banking system, earning the trust of both investors and senior bank officials. At the heart of the scam lay a banking instrument called the Ready Forward, essentially a short-term loan against future securities. Banks used these to manage liquidity, but the process was loosely documented, allowing brokers to request funds without proper collateral, especially through so-called bank receipts, BRs. Mehta's team forged fake bank receipts, claiming they owned government securities that didn't exist. With these BRs, they approached public sector banks, which, trusting the paperwork, released huge sums of cash. In some cases, a single BR of a few crores fetched loans of 10 times that amount. Armed with this cash, Mehta flooded the market with buying orders for select stocks, primarily large, well-known companies like ACC, Reliance, and Hindustan Lever. Within weeks, their share prices surged from a few rupees to over 100, creating a perception of a booming market that attracted even more retail investors. The price rally was spectacular. ACC rose from 70 rupee to 350 rupees, Reliance from 100 rupee to 1200 rupees, and Tata Steel from 90 rupee to 340 rupees. The BSE index jumped from around 2,600 points in early 1992 to a peak of 5,800 by February 1992, an almost 120% rise in less than a year. Public sector banks like State Bank of India and Punjab National Bank were key lenders, largely because Mehta had cultivated personal relationships with senior officials. Meanwhile, the Reserve Bank of India's oversight mechanisms were still developing, allowing these massive, unsecured disbursements to go unchecked. The bubble began to burst when a junior journalist at the Economic Times traced a series of suspicious bank receipts and published an exposé in April 1992. The article triggered a panic among investors and forced the Securities and Exchange Board of India, SEBI, to launch a formal investigation. Within days, the market crashed. The BSE index plunged back to around 3,600 points, erasing billions of rupees in market capitalization. Small investors who had poured life savings into the soaring stocks faced losses estimated at 5,000 crore rupees, while banks scrambled to recover the fraudulent loans. Harshad Mehta was arrested in May 1992, and a high-profile court case followed. In 1995, he was convicted of criminal breach of trust and sentenced to 5 years in prison, though he remained out on bail pending appeal. The case also implicated several senior bank officials and politicians. The fallout spurred sweeping reforms. SEBI was granted greater powers to monitor market abuse. The concept of dematerialization of shares was introduced to curb fake certificates, and banking regulations were tightened to eliminate the Ready Forward loophole. India also moved to AT+ to settlement system for faster, safer trades. The 1992 securities scam remains a cautionary tale about how innovative financial tools, when left unchecked, can be weaponized for fraud. It showed that robust regulation, transparent processes, and vigilant oversight are essential to protect investors and maintain confidence in a growing economy.